Having me. I appreciate being here. Welcome everybody. This is Swinging for the Fences, how to generate huge returns through mispriced options. I just start out with the risk disclaimer. I'll just go over the first couple of lines. Trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. So as we know, these are educational webinars. Whenever I talk about specific names or levels, it's just where I see value in the market, not a trade recommendation for any one person. So let's get going. So for those of you who are not familiar with me, my name is Jonathan Rose. I'm the owner of Active Day Trader. I've been trading professionally for 18 years. I got in the business in 1997, and I was a floor trader at the Chicago Mercantile Exchange. I traded NASDAQ futures for 4 to 5 years, and after that I joined a proprietary trading shop trading fixed income. Did that for 8 years. I was the 6th employee, and we built it up to 150 people, and we sold out to a major hedge fund in the Chicago area. And I was able to take a year off because they put me under a non-compete. They asked me not to work for a year. So I did the Ironman triathlon. It was just one of those things to kind of knock off my bucket list. Something I don't want to do again, but glad I did. And then I spent the last 4 years as a market maker, market making options on the Chicago Board Options Exchange. And the last 4 years is where I really fine-tuned my ability to value options, because as a market maker, you're required to make markets on over 100 names, thousands of strikes. So the real expertise that you need is you need to be able to value all options to the penny. And so that's what I really learned being a market maker, and that's why I'm going to talk about the topic that I'm going to talk about today. So let's get going. So what we're going to discuss, I'd like to just introduce a very straightforward strategy that I think will help you. And what we're looking to do is we're looking to buy out-of-the-money options, out-of-the-money calls, out-of-the-money puts. And I know a lot of people are intimidated or not so comfortable buying out-of-the-money options because they've had really poor experience with it. And I think it's a difficult trade to do on your own if you're not really familiar with how to really value these things. And that's what we're going to discuss today. Absolutely no options experience necessary. This is extremely beginner friendly. And what I want you to think is if the underlying is trading 10 and we buy 10 of the 12 calls, think of that like you're buying stock at 12. Why would we buy stock at 12 when it's trading at 10? Well, we get massive leverage to do that. So if you buy a 10 lot, you're long 1,000 shares. Yeah. Travis, does that look a little bit better? Just getting a few requests to make the screen larger. Okay. So this is actually how I teach options. This is how I learned options, learning to buy out of the money, because it's very straightforward. In that previous example, if the stock's at 10 and we buy those 12 calls for 30 cents 10 times, we're risking $300. We can't lose more than $300. If that stock goes to 1 or if it goes to 1,000, we can only lose $300. So it's very straightforward. This approach builds the foundation to trade options forever, and I'm going to encourage you to look at your portfolio as a whole, not to look at each position as different silos. Looking at if you have 5 positions or 10 positions, looking at them as a group. On the right, it's just a chart of the overall options volume since inception. Options started in 1973. A little slow to start, as we can see, but in 2000 there was just a meteoric rise in options volume. And then in 2015 was the first year where the overall notional value of the options market was larger than the equity market. So if you're trading equities, you should be paying attention to the options market as well. You don't have to necessarily trade the options market, but if the options are overall 50% of the notional value of the overall market, it's too big not to pay attention to. So this was my wow moment with this strategy. In front of you is a stock, SRPT. When I was a floor trader, we called this guy Serpent, SRPT. Now, Serpent has event risk, also called jump risk. It's the same thing. And I find that people have a very difficult time valuing event risk in options. And event risk just means that a stock has the ability to close at 30 and reopen the next day at 50, or close at 40 and reopen the next day at 15. SRPT, you can see from the chart, it really jumps around. Now your Apples, your Amazons, your Netflix, those don't really have jump risk. Maybe they'll jump after earnings, but overall, Apple's not gonna, we're not gonna go to sleep when Apple's 100 and we're gonna wake up and it's gonna be trading 170. That's not really how that stock trades. In 2012, I sent this email to a desk that I was managing of market makers. Hey guys, Barron's ran a one-pager on SRPT. SRPT was quoted as developing a godsend drug for muscular dystrophy. The stock's trading at $10.50. Barron's thinks the stock could trade for $26. I sent this out to my desk, suggesting that we should look to buy some upside calls. Stock's at $10.50. A couple of days later, I was able to buy 40 of the SRPT 14 calls for 30 cents. Now again, stock's at $10.50. I'm buying stock at 14. Most likely, I'm going to lose money. That's a 37% move. That's a big move. My risk, 30 cents, 40 times 30 cents, $1,200. I can't lose more than $1,200. There was actually 200 that came in that order, and the desk took the rest of those trades. A couple of days later, SRPT, which I circled, had one of these massive jumps, traded all the way up to 45. I was able to get out of my 40 for a $104,000 gain. After this, I became obsessed with trying to find these little options. And the more I looked into them, the more I could see that they were off value. And what really made me get into these trades is, as a market maker in 2011, 2012, if the last trade of an option was $1, the market makers would be 60-cent bid at $1.40. Really good for the professional, because if you wanted to sell those options, if I'm 60-cent bid and that's the best option, you got to sell 60 cents. Well, 2012, 2013, 2014, automated trading started to take hold of the options market just like it did in the equity market. So those markets that used to be 60 cents at $1.40 were 80 cents at $1.20, 90 cents at $1.10. They kept getting tighter and tighter and tighter, which was horrible for the professional, but it was really good for the retail trader. And so that's why I stopped market making and said, hey, if these markets are going to be so tight, I'm jumping over to the retail side to take advantage of little stocks that are priced inefficiently and the markets are just too tight. So the swinging for the fences strategy, again, beginner friendly, no options knowledge required. Everything we'll need is going to be provided, or actually we'll go over in this presentation. The end result, what we're looking to do is we're looking to find options that are less than 40 cents, less than 50 cents, and we could sell for over $2, $3, $4. We're going for big fish. Risk, we can never risk more than we're betting. You could bet small, bet big, no difference. There's no margin needed because we're just buying. That SRPT example, I bought 40 for 40 cents. You could have bought one for $40. okay? Because there's no margin. It's good for small accounts or big accounts. It just doesn't matter. Who is this trade for? I personally think everybody should be using out-of-the-money options in their portfolio. I personally use about 10–15% this strategy for my overall portfolio. I'm a very methodical, risk-averse trader when it comes to my overall portfolio, but I use this portion, the 10%, 15%, to take a bunch of shots, to try to make really big returns with some, if the trade's going really well and there's excess capital, great. I want to play and try to find these little options. So I think it's for everyone. If you can't or hate staring at the market all day, like me, again, I've been doing this for 18 years. I have no interest of just death staring the market all day. I find that to be terribly inefficient. I'd rather work on finding good trades, then I put the trades in, and then I trust the work that I've done. If I'm buying options for 20 cents and I buy a 10 lot, that's $200 of risk. There's no stop. Once I get in that trade, I'm okay risking $200 because in the options market, what could my stop be? 15 cents, a dime, 5 cents? I don't want to sell options that cheap anyway. So there's not much management that you need to do with these trades. Small and big accounts, if you're dissatisfied with the risky strategies or performance, and again, this is good for any account size. Why this trade makes sense? Really, automated market makers. Automated market makers are very efficient when they're market making for Apple or Amazon or Netflix. But once they get past those top 30 names, they're using the same kind of logic, but they're not factoring in the jump risk or the illiquidity of a lot of these options. I like it because I have the pick of the litter. As a market maker, you have to trade over 100 stocks. Now, I can pick 1, 2, 3, 4, wherever the best opportunity is. It's uncorrelated to my portfolio. Most of my overall investment portfolio does well when the market goes higher. This kind of approach, you can do well when the market goes higher, but you could also, when you're buying little puts, it becomes a hedge for your overall portfolio. Some of my clients don't do any of the calls, they just do the puts and use that to protect your overall portfolio. When the market goes down, volatility goes higher. So if you're buying puts, you're long volatility, you want movement. So when the market goes down, you're winning on volatility and direction with those puts. And I make a living using it. I trade for a living. I use this strategy, again, 10–15%. So I've trained over 100 traders. Being in the business for a long time and bouncing between different markets, I'm always doing that because the market's changing and the market's evolving. And this is what I find with traders. On the left, stock market efficiency. And on the bottom, years. Take it out to 20 years, and on the left, put your own business in there. Now the market, the purple line, is going to continue to grow. It's going to evolve, okay? Automated trading, dark pools, big block trades. These weren't around 10 years ago. I trade completely different than I did 2 or 3 years ago because you have to constantly change your game, just like any other business. Traders, what I found, make some money sometime in their career, and then they spend a lot of time complaining that the market's a bad trade or this isn't working, and they sit around waiting for the market to come back to them. And I think we could probably all agree that business or the market is not going to come back to people. We have to go keep up with the ever-changing environment. And so that's what I like to do. This trade makes sense to me because the markets have gotten squeezed, have gotten tighter in the options market because of automated trading. So that creates opportunity for these kind of trades. A quick discussion on risk management because it plays into this kind of trade. Quick story, which is a Vegas folklore story. Husband and wife go to Vegas. They bring $1,000 to gamble with. After the first day, they lose all their money, go upstairs, and go to sleep. Husband wakes up in the middle of the night, finds a $5 chip next to the bedstand. He goes down and plays roulette. He puts that $5 on the number 17, and it comes in. He wins $175. He does this a few more times and builds it up to $6,000 and keeps playing until he's up $7.5 million. Finally, he puts that $7.5 million all on the number 17, and the ball lands on 18, and he loses all that money. He goes back up to his hotel room. His wife asks, "Hey, honey, where have you been?" "Oh, I was downstairs playing roulette." "Really? How did you do?" "Not bad. I just lost $5. Now, this example, this is mental accounting. That's not really my money. That's the house's money, so I can play differently. Well, people don't realize how much it comes in to your trading. And Google mental accounting, and there's so much information about it, and it's so interesting, it is to me, of why people spend more when they have on credit card versus cash. Why people will spend differently when they get tax return money back. Okay? It factors in to trading because we need to constantly stick with our discipline. Next 3 slides, some basic options knowledge, and this is everything that we'll need for the swinging for the fences strategy. Buying versus selling options. Now, this is an overview of the options market. People who buy options, you're going to lose 90, 80, 70% of the time. But when you make money, you have to make sure those winners are a good deal more than those losers. And you're long volatility. Whenever you buy calls or buy puts, you're long volatility. You want lots and lots of movement. Now, the people who sell options, you're going to have 90% winners, 80% winners. But when you lose, you're going to lose a lot more than you're going to win. And you're short volatility. You just want everything to be quiet. Now, I can sit here and say, hey, I've got a strategy that makes money 99% of the time. We're selling little out-of-the-money options. You'll make money 99% of the time doing this kind of strategy, but that one time you lose, it's going to be really, really, really bad. So that's why we can't just trust, great, I want to be in this because it makes money 90% of the time. That would scare me to death because I'd be so scared about the tail risk or the big risk that would come on that little 5%. Next, options valuation. Options across the street are valued using the Black-Scholes model. Black-Scholes only has 5 inputs, and the 5 are in front of you. The 5 inputs to value options using the Black-Scholes model: underlying stock price. Let's use Apple. If we want to buy some Apple calls, we know the underlying stock price. We know the option strike price that we choose to buy. We're going to know how much time there is until expiration, and we're going to know the interest rate, right? We could just use the 2-year, 5-year interest rate. The only subjective component of options valuation is volatility. If you're in the options market and you're not looking at volatility, that's the only subjective component. Every other component is given to us. So that just shows the importance of really understanding what volatility is and how we could use it in our trading. Same stock on the left, same stock on the right. The only difference is on the left, 2 days to go until expiration. On the right, we have 30 days to go. So we have a lot more time, right? Stock, $20. With 2 days to expiration, the 22 calls and the 18 puts, maybe they're worth a dime. Because if we buy those 22 calls and we say we buy them 10 times, that's going to be $100. The most we can lose is $100. But what we're doing if we buy a 10 lot is we're buying 1,000 shares from 22. We're probably going to lose on this trade, but if 20 gets above 22, it's going to be a really big winner. Now, if we go out to 30 days to expiration, now we see the 22 calls, maybe they're worth $1.20, or they're worth $1 or 80 cents. And the reason they're worth more is because there's a lot more time. 24s, 40 cents. Again, 30 days to expiration, there's going to be more time. With only 2 days to expiration, they're going to be worth nothing. 18s, $1.40, and the 16s, 70 cents. Now, can anybody guess, or does anybody know why the calls I valued more than the puts? 24 calls, 40 cents. 16 puts, 70 cents. Nice. Mark, we got the right answer right away, but I think from someone I know, Mark, nice. Exactly. So the reason the 22 calls are worth more than the 18 puts is because of skew. S-K-E-W. And skew, there's skew in every options pricing, but the reason there's skew across the whole market is because the two most popular option strategies, covered calls and buying puts to protect your portfolio. When you do a cover call, you're selling options. Options market makers know that people want to sell calls, so they're going to offer these. They're going to make these cheap. People also like to buy puts. Option market makers know that people want to buy puts, so we're going to bid these up. And we're going to make people pay up for their puts, and we're going to put these lower to make people go chase their calls. And that's why if you start looking at upside, downside, you're going to see the downside a little bit more expensive than the upside. The one industry where it's flipped, where the upside is pricier than the downside, is going to be your biotechs. And that's because they have massive jump risks to the upside, and they usually, if they get a great result, they can go up 200, 300, 400%, who knows. But biotechs are the only industry that's consistently have upside skew. So for this strategy, two things that we need. We need stocks that move, but we also need tradable options. Here's two examples of stocks that move that we use or have used in the swinging for the fences strategy. ANFI, 52-week range, high of 25, low of $3. ANFI is a stock that really likes to move. TTM, Tata Motors, high of 52 or 51.80, low of 21. Another stock that really likes to move. I'm a big believer that when TTM goes from 52 all the way down to 21 and back up to 30, what's the difference between 34 and 26 when the stock starts moving like this? I mean, is the valuation of the company changing so fast? So for me, if I think 34, 28, what's the difference? These are names that I look for to buy little options. Next, we want tradable options. Tradable options is there's actually a market to trade, because a lot of these really volatile names might not have the best markets. So we have to go through and find stuff that's super volatile, but that's also we can transact. Here's a stock that we trade, BSQR, 1266 to $6, high to low. Tradable options, 20 cents at 30 cents. That is a very, very good market for the retail community. As a professional market maker, I would never be this tight on this kind of market. I would be 15 cents at 40 cents. I would have some edge. There's not much edge that the market makers have in this market. So why I like to trade like this? Again, we set it and forget it. Once you put your position on, it's on. We're looking to get paid on higher odds than we're risking. It's a super straightforward strategy. It's a great way to get into options, and it's a great way to diversify your overall portfolio. Diversifying improves our returns and reduces risk. And again, there's not many trades where we're actually on the right side of technology. And we're on the right side of technology because of the automated market making. So this is the process that we go through to learn. We learn how to screen. We learn how to find these names. After we learn how to screen for these names, we want to find tradable options. We want to make sure that they're actually markets that we can transact. And then after that, we use technical analysis to figure out, do we want calls? Do we want puts? Maybe we want both. But this is the process. We keep things really simple. For the screener, I use FinViz. I use FinViz because this is a screener that everybody can use. I'll throw it in the chat. This is just a free screener that's really, really just a great tool. And the way we use it is just go screener, close this down, all, and there you go. This is just a really powerful screener that we use for swinging for the fences, just because it's something that everybody can use. I'm going to open up my TOS here and go through a couple of trades. Give me a second. I have this on percentage, so I just want to take it off percentage. There you go. Okay. So, a stock that we had last week, MXWL. MXWL had earnings, but you can see it's a really, really volatile name. The trade that we had was the 6 puts. We had them for a dime. 6 puts we had for a dime. Now they're 70 cents, 80 cents. Now the stock dropped down to $4.80. If we're long the 6 puts, if we're long 10 of them, we're short 1,000 shares from 6. So when the stock drops down to $4.80, you can either cover in your options or you could actually just buy stock. CSIQ is another name that we trade often in the strategy. CSIQ is a solar name that is just all over the place. Who knows where this thing is valued at? And what we were looking at last week, actually February now expired. Oh, I guess, oh. So is the expiration that expired last week. So we were looking at the 17.5 puts, and the stock got down to 15, and then we were looking at the 17.5 calls once the stock got down to 15, and you can see CSIQ, if I take it on a shorter term, CSIQ got down to 15. That's when we looked to cover our puts, and we sent out a trade alert, and then we got into the 17.5s, and we were able to take advantage of the upside. This stock in 1 week goes from 20 down to 15 up to 20 with no earnings at all, just on natural movement of CSIQ. What about WTW? Did you guys see the movement in WTW this past week? WTW on a shorter time frame. This is last week, 11 all the way up to 15. That's a big, big move. But this stock is not something that we're going to use for swinging for the fences strategy. And I'll show you why. Now I talk about valuing options. Weight Watchers 15. Look at the upside. The 22 calls. If I want to buy these, say I put a 50-cent bid in and I can buy them for 50 cents, a 10 lot's $500. 22 calls, the stock's at $15. That's a $7 move that I need in this stock. That is ridiculously high volatility, so there's no reason we would ever be in this trade. It's just absolutely insane. 25 cents, 30 cents to be in these. The stock's at 15. So yes, it's very, very volatile, but just because a name's volatile doesn't mean it fits in with our strategy, because again, what this strategy does is it teaches you how to buy options that are properly, that have good value, or that we can buy inexpensively. The workshop, again, we teach how to screen. Then we find the trades, find the best strikes for the trades that we're looking to do. Risk, we can only lose what we're willing to bet. You can just set it and forget it. Also, once people get more familiar with my methodology and learning this approach, the next level would be how to manage your position. And that's when we talk about scalping gamma. And some of the premier members that we have are getting really good benefit once you learn how to manage your options position. And by scalping gamma, that teaches you how to manage your options position with stocks. I find a lot of the retail community, kind of broadly speaking, just to generalize, will buy options and they get out of their options by selling those options. I like to buy options, and I'm either going to get out by selling options, I can get out with a spread, or I can get out with the underlying stock. And that's a really big breakthrough for people once they start to get flexible with their exits in stocks. A couple of testimonials, kind of running short on time. I have 10 minutes and I want to make sure I get to all questions. So I won't go through all these. This was a great one. I'm trying to figure out if your service is worth it. I paid $297 and have a profit of $9,600. So that was really nice from Dave, but we have tons of these testimonials. So here's what you get. Swing for the fences. It's a 90-minute on-demand workshop. Watch it as many times as you like. Additionally, 3 weeks of my home run options trade service. We start this 2 weeks after your purchase because I want people to absorb the information of the strategy. If we started it this Sunday, I don't think people will have time to really absorb the information by then. The trade service comes out Sunday evenings with a minimum of 5 out-of-the-money trades that are all 50 cents or less. And we're doing this for $297. And that's activedaytrader.com/swing for all who are interested. With all of Active Day Trader products, 30-day money-back guarantee, no questions asked. This has to work for you, and if it doesn't work for you, then it doesn't make sense for me either. So I'm going to go through. I'd like to open it up for any questions. Just give me a second here to set up the screen. Do we buy weekly or monthly options? We buy weekly or monthly options. The more time that we have, the more expensive those options get. So a lot of the options that we have are going to be 1 week, 2 week, or 3 or 4 week maybe. But on the real volatile stuff, you can't go out too far because again, we're looking for cheap options. My definition of tradable options is 20 cents at 40 cents. 25 cents at 40 cents, something like that. I'll go through, WTW. These are tradable to me. Whenever I'm buying options, it's always, if 65 cents at 80 cents, always be 70 cents bid. All you have to be is the best bid. Options markets has the national best bid and offer, which says if I'm the best bid at 70 cents, that option can't trade anywhere for under 70 cents. Stocks don't have that. What's the batting average? This is our home run options going up, what's that, 7 weeks. These are the names. This is what it looks like. You can see the whole time, 2 weeks, 3 weeks, 4 weeks, just depending on, like February just expired. So now our options are going to expire in the 3rd week of March. So then we're going to have a little bit longer term. And so the success rate, it looks like here, 6 names, 3 wins, 2 losses, 1 scratch. 50% here, 4 out of 6 here, 2 out of 5, 3 out of 5. So it's usually 2 out of 5, 3 out of 5. Remember, it increases our batting average once we learn how to manage these positions. And that's why it's so important to, once we absorb the information, to get familiar with how to manage our options through stock. And the real basic example, and I'll go through this, is stocks at 10, and we own 10 of the 12 calls. We're long 1,000 shares from 12, right? If that stock jumps to 15, and we're long 1,000 shares from 12, you can sell 1,000 shares at 15. You can sell 500 shares at 15. If you sell 1,000 shares at 15, you just took all your risk off the table. You now have 0 risk. Because if that stock goes to 20, you're long 1,000 from 12, short 1,000 from 15. Here's the great thing, though, about using stock to manage your options position. In that example, long stock from 12, short 1,000 shares from 15, you're flat, you have no risk. But what happens if that stock comes out with accounting problems and terrible news and it drops down to $5? You never touched your options. You're long 1,000 from 12, but that 12 is now out of the money, so those 12s are going to be worthless. You're still short 1,000 from 15. You can buy back your stock and your options go out worthless. So you're still staying in the game by not covering your options. The scanning we go over in the workshop. How do we scan for options in FinViz? Well, again, the workshop covers all options, but right here, there's an options. You can just click on optionable. And so they'll give us the 4,000 which are optionable, and then fill in whatever you'd like to fill in. We screen for, we want stocks that are going to move. And after we find stocks that are going to move, we teach you how to value those stocks. The time frame that we use, John, being an options trader, I look at value. So the way that I trade is I always need a fundamental reason to get into a trade, and then I use my technicals after that. But not only for swinging for the fences, every trade that I do, I need more than just technicals to risk money. I just do. Gerald's asking, are we looking for low-price stocks with high volatility? The price of the stock doesn't matter. The price of the stock can be $5, $50, or $100. What we're looking for is stocks that are priced inexpensive relative to how they historically move, or stocks that are priced inexpensive in the options market relative to how they're moving right now. Michael, shorter time frame equals a lower chance of success. I absolutely agree. It also equals a higher payout. What we're looking for is 10-to-1 payouts if we can get in at 5-to-1. We're looking to get big payoffs and just get in at better odds. That's what we're looking for. The cost of the option service, the home run option service, after is $99 if you want to continue with it, but you'll know how to find these yourselves after that. I do have some clients who are perfectly knowledgeable enough to do the scans, but they prefer I do it every weekend anyway. Bob's asking if I sell options. Bob, I trade every strategy there is in the options market. This is something that I use for 10-15% of my overall portfolio. The only time I use it for more than that is if I go on vacation, because I don't mind buying a lot of 20-cent options to try to get a nice return. Why do some options trade with a nickel and some with a penny? It's usually the more liquid stuff trades with a penny. Oh, Al, thank you. Yes, thank you. Roger is saying, does open interest play a big part in your decision? Not for these. Not really. James, what account size is needed? The great thing about this strategy is you can buy one option for a dime, which is $10, and there's no margin at all. So this is great for small accounts. This is great for big accounts. And it's really great to paper trade to learn the strategy, because this is exactly how I learned to trade options. Once you learn how to value options like this, it's easy to start getting into straddles and strangles, and not only can you value inexpensive, then you start to value the expensive stuff, and you can start to learn how to sell options. If you don't have capital to manage through stocks, you can just manage through the options. You don't need that. That's just another layer that you can add on top of it. Guys, I have about 20 more questions and about 30 more seconds. My email, jonathan@activedaytrader.com. I'll go through all these questions, but please, I'll put my email in the chat. Email me directly. activetrader.com, and I will definitely get back to you. I appreciate all the questions. I'm sorry I'm running out of time here. So again, swinging for the fences, 90-minute class on demand. Watch it as many times as you want. I'm sorry, I put my email wrong. Jonathan@activedaytrader. I'm running out of time so much, I'm cutting my email short. This is being recorded.
Yes, it is. And Jonathan, just a reminder that I will let you, I'll dismiss you, so don't dismiss the webinar, or else we'll all get booted here, and that'd be a bummer. But thank you very much, Jonathan Rose. Is there anything you'd like to finish with? You want to send out your link one more time?
Sure. No, thank you. Thanks, Travis. Yeah, it's activedaytrader.com/swing. My apologies for all the questions that I don't have time to get to. Please, Jonathan@activedaytrader.com, and I'll be happy to answer you directly. So thank you for inviting me to present, and I really appreciate all the questions. Thank you. Thanks, Travis.